Product mix decisions are an important aspect of management accounting and strategic planning because organizations often produce multiple products or services while operating under resource constraints. Within the program framework, product mix analysis focuses on determining the optimal combination of products or services that maximizes profitability, contribution, or organizational value. The decision becomes particularly important when resources such as labor hours, machine hours, raw materials, production capacity, or sales opportunities are limited. Management accountants use cost and contribution information to evaluate alternative production combinations and allocate scarce resources effectively. A well-designed product mix supports profitability, efficiency, and achievement of organizational objectives. The foundation of product mix analysis is contribution, which represents sales revenue less variable costs. Under marginal costing principles, contribution measures the amount available to cover fixed costs and generate profit. When resources are unrestricted, organizations may seek to maximize total contribution by producing all profitable products. However, when a limiting factor exists, management must determine which products generate the highest contribution relative to the scarce resource. Contribution per unit alone may not be sufficient for decision-making. Instead, contribution per unit of the limiting factor often becomes the most relevant measure for evaluating product profitability. Limiting factors play a central role in product mix decisions because they restrict the level of output that can be achieved. Common limiting factors include machine capacity, skilled labor availability, material shortages, production space, or market demand. For example, if machine hours are scarce, management should prioritize products that generate the highest contribution per machine hour. Similarly, if labor is the limiting factor, contribution per labor hour becomes the relevant measure. By focusing on the contribution generated by scarce resources, organizations can maximize overall profitability while operating within existing constraints and resource limitations. Product mix analysis frequently involves ranking products according to their contribution per unit of the limiting factor. Management accountants calculate the contribution generated by each product and divide it by the amount of the scarce resource required. Products are then prioritized from highest to lowest contribution per limiting factor unit. Available resources are allocated first to the highest-ranked products until demand is satisfied or the limiting factor is fully utilized. This structured approach ensures that scarce resources are directed toward the most profitable opportunities and that organizational performance is optimized within operational constraints. Modern organizations often face complex product mix decisions involving multiple products, diverse customer segments, and dynamic market conditions. In addition to contribution analysis, managers may consider qualitative factors such as customer relationships, strategic importance, market positioning, brand reputation, and long-term growth potential. A product with a lower short-term contribution may still be retained because it supports key customers, complements other products, or strengthens competitive advantage. Consequently, product mix decisions should combine quantitative analysis with strategic judgment to ensure that financial objectives remain aligned with broader organizational goals. In conclusion, product mix analysis is a valuable management accounting technique that helps organizations allocate scarce resources effectively and maximize profitability. By applying marginal costing principles and focusing on contribution, management can identify the most beneficial combination of products or services under limiting factor conditions. Contribution per unit of the limiting factor provides a powerful decision-making tool when resources are constrained. However, successful product mix decisions also require consideration of strategic and qualitative factors that influence long-term organizational success. Through effective product mix analysis, organizations can improve resource utilization, enhance profitability, and support sustainable competitive advantage.